In this video, I will read Berkshire's letter to its shareholders in 2018. To the shareholders of Berkshire Hathaway Inc., Berkshire earned $4.0 billion in 2018 utilizing generally accepted accounting principles, commonly called GAAP. The components of the figure are $24.8 billion in operating earnings, a $3.0 billion non-cash loss from an impairment of intangible assets, arising almost entirely from our equity interest in Kraft Heinz, $2.8 billion in realized capital gains from the sale of investment securities, and a $20.6 billion loss from a reduction in the amount of unrealized capital gains that existed in our investment holdings. A new GAAP rule requires us to include that lost item in earnings. As I emphasized in the 2017 annual report, neither Berkshire's vice chairman, Charlie Munger, nor I believe that rule to be sensible. Rather, both of us have consistently thought that at Berkshire, this mark-to-market change would produce what I described as wild and capricious swings in our bottom line. The accuracy of that prediction can be suggested by our quarterly results during 2018. In the first and fourth quarters, we reported GAAP losses of $1.1 billion and $25.4 billion respectively. In the second and third quarters, we reported profits of $12 billion and $18.5 billion. In complete contrast to these gyrations, the many businesses that Berkshire owns delivered consistent and satisfactory operating earnings in all quarters. For the year, those earnings exceed their 2016 high of $17.6 billion by 41%. Wide swings in our quarterly GAAP earnings will inevitably continue. That's because our huge equity portfolio, valued at nearly $173 billion at the end of 2018, will often experience one-day price fluctuation of $2 billion or more, all of which the new rule says must be dropped immediately to our bottom line. Indeed, in the fourth quarter, a period of high volatility in stock prices, we experienced several days with a profit or loss of more than $4 billion. Our advice: focus on operating earnings, paying little attention to gains or losses of any variety. My saying that in no way diminishes the importance of our investment to Berkshire. Over time, Charlie and I expect them to deliver substantial gains, albeit with highly irregular timing. Longtime readers of our annual reports will have spotted the different way in which I opened this letter. For nearly 3 decades, the initial paragraph featured the percentage change in Berkshire's per share book value. It's now time to abandon that practice. The fact is that the annual change in Berkshire's book value, which makes its farewell appearance on page 2, is a metric that has lost the relevance it once had. 3 circumstances have made that so. First, Berkshire has gradually morphed from a company whose assets are concentrated in marketable stocks into one whose major value resides in operating businesses. Charlie and I expect that reshaping to continue in an irregular manner. Second, while our equity holdings are valued at market prices, accounting rules require our collection of operating companies to be included in book value at an amount far below their current value, a mismark that has grown in recent years. Third, it is likely that over time Berkshire will be a significant repurchaser of its shares. Transactions that will take place at price above book value but below our estimate of intrinsic value. The math of such purchase is simple. Each transaction makes per share intrinsic value go up, while per share book value goes down. That combination causes the book value scorecard to become increasingly out of touch with economic reality. In future tabulation of our financial results, we expect to focus on Berkshire's market price. Markets can be extremely capricious. Just look at the 54-year history laid out on page 2. Over time, however, Berkshire's stock price will provide the best measure of business performance. Before moving on, I want to give you some good news, really good news, that is not reflected in our financial statements. It concerns the management changes we made in early 2018, when Ajit Jain was put in charge of all insurance activities and Greg Abel was given authority over all other operations. These moves were overdue. Berkshire is now far better managed than when I alone was supervising operations. Ajit and Greg have rare talents, and Berkshire blood flows through their veins. Now let's take a look at what you own. Focus on the forest, forget the trees. Investors who evaluate Berkshire sometimes obsess on the details of our many and diverse business, our economic trees, so to speak. Analysis of that type can be mind numbing, given that we own a vast array of specimens ranging from twigs to redwoods. A few of our trees are diseased and are unlikely to be around a decade from now. Many others, though, are destined to grow in size and beauty. Fortunately, it's not necessary to evaluate each tree individually to make a rough estimate of Berkshire's intrinsic business value. That's because our forest contains 5 groves of major importance, each of which can be appraised with reasonable accuracy in its entirety. 4 of those groves are differentiated clusters of businesses and financial assets that are easy to understand. The fifth, our huge and diverse insurance operation, delivers great value to Berkshire in a less obvious manner, one I will explain later in this letter. Before we look more closely at the first 4 groves, let me remind you of our prime goal in the deployment of your capital: to buy ably managed businesses, in whole or part, that possess favorable and durable economic characteristics. We also need to make these purchases at sensible prices. Sometimes we can buy control of companies that meet our tests. Far more often, we find that attributes we seek in publicly traded businesses, in which we normally acquire a 5% to 10% interest. Our two-pronged approach to huge-scale capital allocation is rare in corporate America, and at times it gives us an important advantage. In recent years, the sensible course for us to follow has been clear. Many stocks have offered far more for our money than we could obtain by purchasing businesses in their entirety. That disparity led us to buy about $43 billion of marketable equity last year, while selling only $19 billion. Charlie and I believe the companies in which we invested offered excellent value, far exceeding that available in takeover transactions. Despite our recent additions to marketable equities, the most valuable grove in Berkshire's forest remains the many dozens of non-insurance businesses that Berkshire controls, usually with 100% ownership and never with less than 80%. Those subsidiaries earned $16.8 billion last year. When we say earned, moreover, we are describing what remains after all income taxes, interest payments, managerial compensation, whether cash or stock-based, restructuring expenses, depreciation, amortization, and home office overhead. The brand of earnings is a far cry from that frequently touched by Wall Street bankers and corporate CEOs. Too often, their presentations feature adjacent EBITDA, a measure that redefines earnings to exclude a variety of all too real costs. For example, management sometimes asserts that their company's stock-based compensation shouldn't be counted as an expense. What else could it be? A gift from shareholders? And restructuring expenses? Well, maybe last year's exact rearrangement won't recur, but restructuring of one sort or another are common in business. Berkshire has gone down that road dozens of times, and our shareholders have always borne the costs of doing so. Abraham Lincoln once posed the question, if you call a dog's tail a leg, how many legs does it have? And then answered his own query, 4, because calling a tail a leg doesn't make it one. Abby would have felt lonely on Wall Street. Charlie and I do contend that our acquisition-related amortization expenses of $1.4 billion, detailed on page K84, are not a true economic cost. We add back such amortization costs to GAAP earnings when we are evaluating both private businesses and marketable stocks. In contrast, Berkshire's $8.4 billion depreciation charges charge understates our true economic cost. In fact, we need to spend more than this sum annually to simply remain competitive in our many operations. Beyond those maintenance capital expenditures, we spend large sums in pursuit of growth. Overall, Berkshire invested a record $14.5 billion last year in plant, equipment, and other fixed assets, with 89% of that spent in America. Berkshire's runner-up growth by value is its collection of equities, typically involving a 5% to 10% ownership position in a very large company. As noted earlier, our equity investments were worth nearly $173 billion at year-end, an amount far above its cost. If the portfolio had been sold at its year-end valuation, federal income tax of about 14.7 billion would have been payable on the gain. In all likelihood, we will hold most of these stocks for a long time. Eventually, however, gains generate taxes at whatever rate prevails at the time of the sale. Our investees paid us dividends of $3.8 billion last year, a sum that will increase in 2019. Far more important than the dividends, though, are the huge earnings that are annually retained by these companies. Consider, as an indicator, these figures that cover only five largest holdings. So we hold American Express, Apple, Bank of America, Coca-Cola, and Wells Fargo. GAAP, which indicates the earnings we report, does not allow us to include the retained earnings of investees in our financial accounts. But those earnings are of enormous value to us. Over the years, earnings retained by our investees have eventually delivered capital gains to Berkshire that totaled more than $1 for each dollar these companies reinvested for us. All of our major holdings enjoy excellent economics, and most use a portion of their retained earnings to repurchase their shares. We very much like that. If Charlie and I think an investee stock is underpriced, we rejoice when management employs some of its earnings to increase Berkshire's ownership percentage. Here's one example drawn from the table above. Berkshire's holdings of American Express have remained unchanged over the past 8 years. Meanwhile, our ownership increased from 12.6 to 17.9 because of repurchases made by the company. Last year, Berkshire's a portion of the $6.9 billion earned by American Express was $1.2 billion. About 96 of the $1.3 billion we paid for our stake in the company. When earnings increase and shares outstanding decrease, owners over time usually do well. A third category of Berkshire's business ownership is a quartet of companies in which we share control with other parties. Our portion of the after-tax operating earnings of these businesses, 26.7% of Kraft Heinz, 50% of Berkshire, and Electric Transmission Texas, and 38.6% of Pilot Flying J, totaled about $1.3 billion in 2018. In our fourth growth, Berkshire held $112 billion at year-end in U.S. Treasury bills and other cash equivalents, and another $20 billion in miscellaneous fixed income instruments. We consider a portion of that stash to be untouchable, having pledged to always hold at least $20 billion in cash equivalents to guard against external calamities. We have also promised to avoid any activities that could threaten our maintaining that buffer. Berkshire will forever remain a financial fortress. Imagine, I will make expensive mistakes of commission and will also miss many opportunities, some of which should have been obvious to me. At times, our stock will tumble as investors flee from equities, but I will never risk getting caught short of cash. In the years ahead, we hope to move much of our excess liquidity into businesses that Berkshire will permanently own. The immediate prospects for that, however, are not good. Prices are sky high for businesses possessing decent long-term prospects. That disappointing reality means that 2019 will likely see us again expanding our holdings of marketable equities. We continue, nevertheless, to hope for an elephant-sized acquisition. Even at our age of 88 and 95, I'm the young one. That prospect is what causes my heart and Charlie's to beat faster. Just writing about the possibility of a huge purchase has caused my pulse rate to soar. My expectation of more stock purchases is not a market call. Charlie and I have no idea as to how stocks will behave next week or next year. Predictions of that sort have never been a part of our activities. Our thinking, rather, is focused on calculating whether a portion of an attractive business is worth more than its market price. I believe Berkshire's intrinsic value can be approximated by summing the values of our four asset-laden groves and then subtracting an appropriate amount for taxes eventually payable on the sale of marketable securities. You may ask whether an allowance should not also be made for the major tax costs Berkshire would incur if we were to sell certain of our wholly owned businesses. Forget that thought. It would be foolish for us to sell any of our wonderful companies even if no tax would be payable on its sale. Truly good businesses are exceptionally hard to find. Selling any you are lucky enough to own makes no sense at all. The interest cost of all of our debt has been deducted as an expense in calculating the earnings at Berkshire's non-insurance businesses. Beyond that, much of our ownership of the first four groves is financed by funds generated from Berkshire's fifth grove, a collection of exceptional insurance companies. We call those funds float, a source of financing that we expect to be cost-free, or maybe even better than that, over time. We will explain the characteristics of float later in this letter. Finally, a point of key and lasting importance, Berkshire's value is maximized by our having assembled the five groves into a single entity. This arrangement allows us to seamlessly and objectively allocate major amounts of capital, eliminate enterprise risk, avoid insularity. Found assets at exceptionally low cost occasionally take advantage of tax efficiencies and minimize overhead. At Berkshire, the whole is greater, considerably greater, than the sum of the parts. Repurchases and reporting. Earlier I mentioned that Berkshire will from time to time be repurchasing its own stock. Assuming that we buy at a discount to Berkshire's intrinsic value, which certainly will be our intention, repurchases will benefit both those shareholders leaving the company and those who stay. True, the upside from repurchases is very slight for those who are leaving. That's because careful buying by us will minimize any impact on Berkshire's stock price. Nevertheless, there is some benefit to sellers in having an extra buyer in the market. For continuing shareholders, the advantages are obvious. If the market prices a departing partner's interest at, say, 90 cents on the dollar, continuing shareholders reap an increase in per share intrinsic value with every repurchase by the company. Obviously, repurchases should be price sensitive. Blindly buying an overpriced stock is value destructive, a fact lost on many promotional or ever optimistic CEOs. When a company says it contemplates repurchases, it's vital that all shareholder partners be given the information they need to make an intelligent estimate of value. Providing that information is what Charlie and I try to do in this report. We do not want a partner to sell shares back to the company because he or she has been misled or inadequately informed. Some sellers, however, may disagree with our calculation of value, and others may have found investments that they consider more attractive than Berkshire shares. Some of that second group will be right. There are unquestionably many stocks that will deliver far greater gains than ours. In addition, certain shareholders will simply decide it's time for them or their families to become net consumers rather than continuing to build capital. Charlie and I have no current interest in joining that group. Perhaps we will become big spenders in our old age. For 58 years, our managerial decisions at Berkshire have been made from the viewpoint of the shareholders who are staying, not those who are leaving. Consequently, Charlie and I have never focused on current quarter results. Berkshire, in fact, may be the only company in the Fortune 500 that does not prepare monthly earning reports or balance sheets. I, of course, regularly view the monthly financial reports of most subsidiaries, but Charlie and I learn of Berkshire's overall earnings and financial positions only on quarterly basis. Furthermore, Berkshire has no company-wide budget, though many of our subsidiaries find one useful. Our lack of such an instrument means that the parent company has never had a quarterly number to hit. Shunning the use of this ballgame sends an important message to our many managers, reinforcing the culture we prize. Over the years, Charlie and I have seen all sorts of bad corporate behavior, both accounting and operational, induced by the desired management to meet Wall Street expectations. What starts as an innocent fudge in order to not disappoint the street, say trade loading at quarter ends, turning a blind eye to rising insurance losses, or drawing down a cookie jar reserve, can become the first step toward full-fledged fraud. Playing with the numbers just this once may well be the CEO's intent. It's seldom the end result. And if it's okay for the boss to cheat a little, it's easy for subordinates to rationalize similar behavior. At Berkshire, our audience is neither analysts nor commentators. Charlie and I are working for our shareholder partners. The numbers that flow up to us will be the ones we send on to you. Non-insurance operations, from lollipops to locomotives. Let's now look at further at Berkshire's most valuable growth, our collection of non-insurance businesses. I keep in mind that we do not wish to unnecessarily hand our competitors information that might be useful to them. Additional details about the individual operations can be found on page later. Viewed as a group, these businesses earned pre-tax income in 2018 of $20.8 billion, a 24% increase over 2017. Acquisitions we made in 2018 delivered only a trivial number of that gain. I will stick with pre-tax figures in the discussion, but our after-tax gains in 2018 from these businesses was far greater, 47%, thanks in large part to the cut in the corporate tax rate that became effective at the beginning of that year. Let's look at why the impact was so dramatic. Begin with the economic reality. Like it or not, the US government owns an interest in Berkshire's earnings of size determined by Congress. In effect, our country's Treasury Department holds a special class of our stock, called its holding the AA shares, that receives large dividends from Berkshire. In 2017, as in many years before, the corporate tax rate was 35%, which means that Treasury was doing very well with its AA shares. Indeed, Treasury stock, which was paying nothing when we took over in 1965, had evolved into a holding that delivered billions of dollars annually to the federal government. Last year, however, 40% of the government's ownership was returned to Berkshire, free of charge, when the corporate tax rate was reduced to 21%. Consequently, our A and B shares received a major boost in the earnings attributes to their shares. This happening materially increased the intrinsic value of Berkshire shares you and I own. The same dynamic, moreover, enhanced the intrinsic value of almost all the stocks Berkshire holds. These are the headlines, but there are other factors to consider that tempered our gain. For example, the tax benefits gathered by our large utility operations get passed along to its customers. Meanwhile, the tax rate applicable to the substantial dividends we receive from domestic corporations is little, charged at about 13%. Overall, however, the new law made our business and the stocks we own considerably more valuable, which suggests that we return to the performance of our non-insurance businesses. Our two towering redwoods in the grove are BNSF and Berkshire Hathaway Energy. Combined, they earned $9.3 billion before tax last year, up 6% from 2017. You can read more about these businesses on page later. Our next 5 non-insurance subsidiaries, as ranked by earnings: Clayton Homes, International Metalworking, Lubrizol, Marmon, and Precision Cast Parts, had aggregate pre-tax income in 2018 of $6.4 billion, up from the $5.5 billion these companies earned in 2017. The remaining non-insurance businesses that Berkshire owns, and there are many, had pre-tax income of $3.6 billion in 2018 versus $3.3 billion in 2017. The next section will be insurance float and the founding of Berkshire. Our property casualty insurance businesses, our fifth growth, has been the engine propelling Berkshire's growth since 1967, the year we acquired National Indemnity and sister company, National Fire and Marine, for $8.6 million. Today, National Indemnity is the largest property casualty company in the world as measured by net worth. One reason we were attracted to the PC business was the industry's business model. PC insurers receive premiums upfront and pay claims later. In extreme cases, such as claims arising from exposure to asbestos or severe workplace accidents, payments can stretch over many decades. This collect now, pay later model leaves PC companies holding large sums, money we call float, that will eventually go to others. Meanwhile, insurers get to invest this float for their own benefits. Though individual policies and claim comes and go, the amount of float an insurer holds usually remains fairly stable in relation to premium volume. Consequently, as our business grows, so does our float, and how it has grown, as the following table shows. So it shows that in 1970s, the float is $39 million, and in comparison in 2018, the float is $122 billion. We may in time experience a declining float. If so, the decline will be very gradual. At the outside, no more than 3% in any year. The nature of our insurance contracts is such that we can never be subject to immediate or near-term demands for sums that are significant to our cash resources. That structure is by design and is a key component in the unequaled financial strength of our insurance companies. That strength will never be compromised. If our premiums exceed the total of our expenses and eventual losses, our insurance operation registers an underwriting profit that adds to the investment income the float produces. When such a profit is earned, we enjoy the use of free money, and better yet, get paid for holding it. Unfortunately, the wish of all insurers to achieve this happy result creates intense competition, so vigorous indeed that it sometimes causes the PC industry as a whole to operate at a significant underwriting loss. That loss, in fact, is what the industry pays to hold its float. Competitive dynamics almost guarantee that the insurance industry, despite the float income all its companies enjoy, will continue its dismal record of earning subnormal returns on tangible net worth as compared to other American businesses. Nevertheless, unlike our own prospects, Berkshire's unrivaled financial strength allows us far more flexibility in investing our float than generally available to PC companies. The many alternatives available to us are always an advantage and occasionally offer major opportunities. When our insurers are constrained, our choices expand. Moreover, our PC companies have an excellent underwriting record. Berkshire has now operated at an underwriting profit for 15 of the past 16 years, the exception being 2017, when our pre-tax loss was $3.2 billion. For the entire 16-year span, our pre-tax gain totaled $27 billion, of which $2 billion was recorded in 2018. That record is no accident. Disciplined risk evaluation is a daily focus of our insurance managers, who knows that the benefit of float can be drowned by poor underwriting results. All insurers give the message lip service. At Berkshire, it is religion, Old Testament style. In most cases, the founding of a business comes from two sources, debt and equity. At Berkshire, we have two additional arrows in the quiver to talk about, but let's first address the conventional components. We use stats sparingly. Many managers, it should be noted, will disagree with this policy, arguing that significant debt juices the returns for equity owners. And these more venturesome CEOs will be right most of the time. At rare and unpredictable intervals, however, credit vanishes and debt becomes financially fatal. A Russian roulette equation: usually win, occasionally die. Many make financial sense for someone who get a piece of a company's upside but does not share its downside. But that strategy would be madness for Berkshire. Rational people don't risk what they have and need for what they don't have and don't need. Most of the debt you see on our consolidated balance sheet resides at our railroad and energy subsidiaries, both of them asset heavy companies. During recessions, the cash generation of these businesses remains bountiful. The debt they use is both appropriate for their operations and not guaranteed by Berkshire. Our level of equity capital is a different story. Berkshire's $349 billion is unmatched in corporate America. By retaining all earnings for a very long time, allowing compound interest to work in its magic, we have amassed funds that have enabled us to purchase and develop the valuable groves earlier described. Had we instead followed a 100% payout policy, we would still be working with the $22 million with which we began fiscal 1965. Beyond using debt and equity, Berkshire has benefited in a major way from two less common sources of corporate funding. The larger is the float I have described. So far, those funds, though they are recorded as a huge net liability on our balance sheet, have been of more utility to us than an equivalent amount of equity. That's because they have usually been accompanied by the underwriting earnings. In effect, we have been paid in most years for holding and using other people's money. As I have often done before, I will emphasize that this happy outcome is far from a sure thing. Mistakes in assessing insurance risks can be huge and can take many years to surface. A major catastrophe that will dwarf Hurricane Katrina and Michael will occur, perhaps tomorrow, perhaps many decades from now. The big one, many come from a traditional source, such as a hurricane or earthquake, or it may be a total surprise involving, say, a cyber attack having disastrous consequences beyond anything insurers now contemplate. When such a mega catastrophe strikes, we will get our share of the losses and they will be big, very big. Unlike many other insurers, however, we will be looking to add business the next day. The final funding source, which again Berkshire possesses to an unusual degree, is deferred income taxes. These are liabilities that we will eventually pay, but that are meanwhile interest-free. As I indicated earlier, about $14.7 billion of our $50.5 billion of deferred taxes arises from the unrealized gains in our equity holdings. These liabilities are accrued in our financial statements at the current 21% corporate tax rate, but will be paid at the rates prevailing when our investments are sold. Between now and then, we in fact have an interest-free loan that allows us to have more money working for us in equities than would otherwise be the case. A further $28.3 billion of deferred tax results from our being able to accelerate and the depreciation of assets such as plant and equipment in calculating the tax we must currently pay. The front-end savings in taxes that we record gradually reverse in future years. We regularly purchase additional assets, however, as long as the present tax law prevails. This source of funding should trend upward. Over time, Berkshire's funding base, that's the right-hand side of our balance sheet, should grow primarily through the earnings we remain. Our job is to put the money retained to good use of the left-hand side by adding attractive assets.